A lot of our clients really have a strong desire to leave money to children, and even more often we're seeing a strong desire to leave money to grandchildren as well. One of the questions we'll get a lot of times, though, is individuals don't know if it's better to try and make some small gifts now, or if it's better to kind of set their estate plans up to where they can leave the money once they do pass away. How do you usually handle that situation when someone's looking to either give money away now or wait until their ultimate demise?
Yeah, there's a couple of different ways of thinking about it. So a lot of times people think that they're limited to just that $14,000 per year in gifting.
Right, because anybody can gift to anybody that they want to, up to $14,000 a year.
Right. But in actuality, you have a lifetime exemption of several $1 million. I believe it's $4.3 million for your lifetime exemption. So anything over and above that, then you're limited to just the $14,000 for, let's say, your children per year. But to answer your question simply, basically the route that I take typically is using some type of strategy where we can pass it on tax-free to the heirs and beneficiaries and actually grow the portfolio for them.
That's an important point, because I think a lot of individuals have the majority of their assets, their retirement assets, tied up in things like 401ks, 401ks, IRAs, 403bs, things like that. So Jordan, obviously, if someone passes away and they're trying to leave money to their children, if they have one or two children, if they cash those types of plans in, they're going to have to pay a pretty significant amount in tax, right? So what are some things that can be done to try and avoid that?
Well, sometimes we can just roll it into an inherited or a spousal IRA, which again, we don't have to pay taxes until we withdraw from the account. Sometimes, and of course we're not estate planning attorneys, but there's some forms of trust that we can use to defer taxes again in the future. So there's a couple of different strategies that we can do with that, but it really depends again on what their goals are and what their ultimate objective is.
Now, what if they're trying to leave the money to their grandchild? So if they pass away and they leave $200,000 in the IRA, does their grandchild have to cash it in and pay all the tax, or isn't there an inherited IRA or some things that they could do as well?
Yeah, they could put it into an inherited IRA, and then again, they would not have to pay taxes until they withdraw in the future, which is good too, because you wouldn't want to have to pay $200,000 all at once. So there's some strategies you can use with it.
The conversation I like to have when we start talking about the taxes is I like to ask the clients, what do you guys think that taxes are going to do in the future? I mean, are taxes likely to go down from where they are now, or do you think that they're going to go up? And then once we make a decision there as to their comfort level, a lot of times what it makes sense to do is go ahead and start transitioning that over into the tax-free strategy.
Yeah, and you make a good point, because I think if you look at it right now, everybody wants to pay less in tax, but arguably tax rates right now are kind of at historical lows. And I think if you look at the debts and the deficits, things of that nature, they're more than likely going to go up in the future. We don't know for sure, but that's probably the direction things are headed. One of the things I'll point out to individuals as well is that there are some tax strategies that can be utilized to minimize the impact of tax, so children and grandchildren get to keep more of their inheritance money. But another point that I'll sometimes make with individuals is, why not go ahead and try and gift them? Again, we can do the $14,000 per year, and if they're married, well, you can gift $14,000 to your child, and if you trust the in-laws, you can maybe give the $14,000 to their spouse as well. But then if you start to do those types of things, you get to see them enjoy it.
Right.
You get to see your children or your grandchildren enjoy and spend the money, and you get to maybe spend time with them as they enjoy it. I have other clients that I'll talk to that are concerned with the idea that things are changing in the economy. Pensions, for the most part, have kind of gone away. There's concerns over Social Security, and so a lot of our clients are telling me that they really feel like they need to leave as much money as they can to their kids and their grandkids, because they're not going to have the same pension plans and the same opportunities, and you now have households taking two incomes to have the same standard of living that it used to take one. So they're really trying to leave as much money as they possibly can, because they feel like their children and grandchildren are going to really need it. Would that be a scenario then where maybe some of the tax-free strategies that you're talking about, Dustin, would really benefit them in that type of scenario?
Absolutely, yeah, because like you were saying, pensions are almost gone, and I am hearing that more and more, is that how can I set up a retirement plan for my children? And if you set it up with an IRA, well, then you're adding a tax burden potentially to them. So if that's the scenario you're trying to go after, tax-free income is obviously much, much better than taxable.
Now, if somebody's watching right now, Jordan, they're interested in learning more, how difficult is it to try and run an analysis and determine what's best for them, whether they should gift money now or gift money later, or maybe do a combination of both? What would they need to send us or talk with us about in order for us to know exactly what they should do? Because every situation's a little different.
Yeah, every situation is different. I think there's a couple of different things that we can do for them. First and foremost, we want to see what their goals are. So if they're comfortable with paying taxes now, maybe that's a conversation we have. Or if they say, well, hey, I want to set up some sort of a strategy to where we can grow things tax-free, maybe it's that route. But again, every situation is different. So if someone were able to come in, we could take a look at some statements and see what we could do.
So find out what they have currently and obviously what it is that they're trying to accomplish, and then see if there's maybe some ways that we can get that money to their children and their grandchildren tax-free, right? Okay, well, I like it. Well, if you have questions about that, then feel free to give us a call at the office. We'd be more than happy to sit down and discuss your unique situation with you and trying to determine what's best for you.
So what are your goals going to be in retirement? Is it extravagant or is it going to be a little more mild? And what that's going to do is that's going to tell you how much you really need to have in your portfolio in order to retire. In this segment, I want to talk about 5 questions that you should ask yourself before choosing an advisor. Now, people say to me all the time when I go out and some salesman approaches me that I'm almost intolerant or rude. And to me, when I go somewhere, anywhere you go, whether it's to look at washers and dryers or cars or clothes or whatever it may be, you're always being approached by a salesperson trying to sell you something. And they almost never get through to me unless they start talking to me about what that's going to do to make my life easier, unless they start educating me about the topic or the product that they're trying to get me to buy. And then if they can do that and I see that, hey, this really is going to make my life easier, then I'm easily sold. So in this topic, I want to talk about 5 questions that you need to be asking yourself when you're going to choose an advisor. Number 1 is have you really defined your goals in retirement? Are you sure when that retirement date is going to be? What type of retirement are you going to have? Is it going to be to travel the world? Is it going to be you just don't want to go to work anymore and you want to stay around the house and just kind of work around the land, things like that? So what are your goals going to be in retirement? Is it extravagant or is it going to be a little more mild? And what that's going to do is that's going to tell you how much you really need to have in your portfolio in order to retire. And number 2 is, what is your current financial situation? In order to build a plan of where we want to go, we really need to know where we are. So this is where I'll relate a lot to a GPS. So when you're going in your car and you're trying to find directions to a restaurant, well, what it's going to do is it's going to locate where you are, and then it's going to build a plan in order to get you to that restaurant. And if you make some wrong turns along the way, well, that GPS is probably going to say recalculating route, and it's going to figure another route to get you to the restaurant. Well, that's the same way if you're working with someone that specializes in retirement planning, not just financial planning, but retirement planning. What they're going to do is they're going to use safer investments. They're going to use strategies to try and avoid or keep risk at a minimum. And then if there's a bump in the road, it's not going to derail you. They're going to be able to help you recalculate the route and get back on track so that you can retire at the time that you were actually hoping to. Number 3 is when do you need income? So income, is that something that as soon as you retire, you're going to need to start dipping into your 401k or into your 403b in order to start taking income immediately? Or do you even need income? Are you going to be able to live off of the pension that your employer, if you're very lucky, that your employer provided to you, that and Social Security? And then if you are going to need income, how much? Have you figured out what your expenses are going to be in retirement? Are they going to go up because you're starting to travel maybe a little more? Or are they going to go down because you're not doing as much? You know, I was reading something the other day that was talking about Saturdays are the day of the week that you spend the most money. Well, once you go into retirement, every day is Saturday. So if you're going to go into retirement, you may need a lot more income because you're going to get to do a lot more free time. You're going to have a lot more time to go out and do fun things or go out and travel a little bit. Number 4 is how do you feel about market risk? This is somewhere that I see a lot of people. I would say majority of those that are going into retirement don't realize this is one of the biggest mistakes that we see made on a daily basis. People will go into retirement and they'll use the same exact strategy or the same exact tools that they did through their career. And what happens there is you go into retirement and you're expecting that your investments are going to provide income or they're going to be safer, but you didn't change anything. You're using the same tools. So once you go into retirement, now you need to pull some of that risk off the table and make sure that you're not seeing a lot of fluctuation in the value of your portfolio, because that can really start to throw you off track. Number 5 is how involved do you want to be in your investments? Now, this is where I'll see some individuals will actually say they want to manage their own portfolio. And this is where you'll need to know, are you going to have 3 or 4 hours a day to sit in front of a computer and make the adjustments or the tweaks that need to be made on a daily basis? This is another place where I'll see somebody where they'll split their portfolio into, maybe they'll keep a small portion and they'll manage that themselves, and then the bulk of it they'll use a retirement specialist or someone that does this for a living. Because I can see you could really get yourself into some trouble if you're not making sure that you're watching it on a daily basis. So if you have any questions that about some of these things that I had just talked about, please feel free to call us at our office or visit us on our website.
Now, a lot of advisors will tell you to always roll over your 401k, and while that is heard so frequently, that may not always be the most appropriate option, because there are a few reasons why someone would want to keep their 401k. On this week's segment of Strategic Wealth University, we're going to be talking about the decision on whether or not we should roll over our 401k and really what our different options are. So really with a 401k in mind, there's 4 primary options on what we can do with the funds. The options are we can keep it as a 401k because maybe we don't want to roll it over. The next option is that we can move our old 401k into our new 401k. And the reason why we might do that is because maybe we just changed jobs and really we want to consolidate and simplify things, and because of it, we decide that we want to move our monies into our new 401k. Now, the next option that we have is that we can roll our 401k over into an IRA, and that could give us a little bit more control over our account. And then the last option that we have is that we can spend it. Now, spending is the most fun option, but this is for our retirement planning, and that should not be taken lightly. And unless we need the monies for some sort of an emergency, I think it would be much more wise for us to keep the money as an investment. Now, a lot of advisors will tell you to always roll over your 401k, and while that is heard so frequently, that may not always be the most appropriate option, because there are a few reasons why someone would want to keep their 401k. Now, if we take a look at this, one of the reasons to keep it is that our fees may be lower. And a lot of times, institutional investments can be available. And an institutional investment is an entity or group that pools together funds and then invests those funds. Now, an institutional investment could be a mutual fund or something similar to that. Now, with some 401ks, if we're with a large company, because of there being so many people within the 401k, our fees could be much lower. And those are some of the main reasons why we would want to roll over our 401k. But there are also some reasons why we want to roll over our 401k. And our main reason to keep a 401k is because our fees are low. But also a reason to roll over our 401k is because the fees could potentially be high. A lot of times we'll see fees as much as 1% to 2% on our 401ks, sometimes higher, sometimes less, but oftentimes somewhere between 1% to 2%. And another reason why we would want to roll over our funds would be that our current 401k has restricted options. Sometimes we only have access to half a dozen or a dozen investments, and really because of that, your flexibility is limited. Now, if you roll over a 401k, there are more options that may be available outside of our 401k into an IRA. And a lot of times people want to consolidate or simplify things, and that could be another reason to roll over your 401k. I was actually meeting with a woman this week, and she had 7 different 401ks. And really, she didn't even know everything that she had because there were so many different accounts in so many different places. And fortunately, we were able to help give her some peace of mind and help her consolidate the accounts. But it was amazing. There were 7 different accounts, and we will see that oftentimes whenever people come into the office looking for help. And then the last reason to roll over a 401k could be the potential Roth conversion. Now, a Roth IRA, of course, is a tax-free strategy, but if we're rolling over monies from a 401k into a Roth IRA, we'll have to pay taxes on those monies. And oftentimes, it's much easier to roll the 401k into a traditional IRA and then do the Roth conversion there. But really, though, those are the main reasons why we would want to roll over our 401k. But if we look at the biggest reason why, I would have to say it's because of the fees. Fees can have a dramatic impact on our portfolios. And with the smaller 401k plan, your fees oftentimes are going to be much higher. With the bigger 401k, your fees are going to be priced in. Now, something that a lot of individuals don't think about is that with a 401k or a small 401k, you can actually go out and get the same funds on the retail side for a much lower price. So what I mean by that really is the IRA outside of your 401k would get a lot of lower prices. And typically, a lot of times what we'll see is that over time, these fees really can impact our returns. Really, over long periods of time, fees can be a dramatic game changer in our portfolios, either for good or bad. And fees, of course, aren't the end-all be-all, but if the fees aren't justified in performance or safety, they can be inappropriate. And I don't feel that we should ever have to sacrifice performance or safety and at the same time pay more in fees. Now, another big difference is the control of the choices. With the 401k, again, you are limited to what companies are offering you. If you move the 401k or if you move that 401k into an IRA, you have greater control over your accounts. Now, if you want to sit down and visit with us to see if you should or should not roll over your 401k, we'd be happy to sit down and talk with you and share with you what could potentially be some different good options. Now, for more questions from us, please feel free to give us a call or check us out on the website.
So what we always want to do is we want to assign a number. It's called our uncle point. Because everybody's comfortable with a certain amount of risk, but if they get over that, well, they either want to exit the positions they were in or move it into something that's going to protect them from loss. So this week I want to talk about stress testing your portfolio and actually understanding and getting your arms around exactly how much risk is there in your portfolio. People come in all the time and they've been asked, how much risk are you comfortable with? And the standard answer is always, well, I'm conservative, or I'm moderate, or I'm aggressive, conservative to moderate. But what we want to do is we want to put a number on that, because conservative to one person may mean something completely different than it means to another. So what we always want to do is we want to assign a number. It's called our uncle point, because everybody's comfortable with a certain amount of risk, but if they get over that, well, they either want to exit the positions they were in or move it into something that's going to protect them from loss. So this particular client that we're going to talk a little bit about here in the example, his portfolio was worth $440,000. This gentleman came into the office and we ran what we call our risk assessment exercise. And what it does is it has several different options as to how much risk you're actually comfortable with. This gentleman chose portfolio A. And what that means is portfolio A says, yes, I'm willing to take a potential of 5% of a loss in order to gain 10%. Then it also puts a dollar amount on it. So, okay, I'd be willing to push $22,000 off the table in order to gain 44. Now, the next scenario, or portfolio B, is a little bit riskier. So it says, okay, 8.25% is about the maximum that I could stand to lose and not change my lifestyle in order to gain 16.5%. Portfolio C is a little bit more risk, and so on. So what we want to do is we want to understand, okay, how much are you, the client, actually comfortable with risk-wise? So again, this client here chose portfolio A. So then what we're going to do is from that point, we want to stress test his actual portfolio. Now, what stress testing means is we've got a software program that allows us to look over the last 100 years of the stock market's historical data and project pretty closely how your portfolio, or how each portfolio we're managing, would react based on different economic scenarios. So we've got so many scenarios that I could bore you with the information that we have. But what we've done is we've ran 3 of the most popular ones that people are asking about, or we may be hearing about in debates or on the news, things of that nature. So what we're going to do is just kind of scroll through each one of these. First of all, this is going to be a high-level view on the first page here.
we'll go into a little bit more depth as we move along. So the first scenario we're looking at was, what if interest rates start to rise back to a historical normal level of about 5%? Well, this particular portfolio would react by dropping by 18.3% based on that scenario. The next one here is what if we hit that debt cliff? What if we hit that $27 trillion number that we're hearing about, and the U.S. defaults for the first time in history? Now, we all hope that this doesn't happen, but as an advisor, we need to be prepared that if something were to happen like that, that our clients are going to be okay, or as good as they can be. Now, this one here is showing if the U.S. defaults for the first time in history, it would cause a 47.6% decline in the total value of this portfolio. The last one here is what if we went through another scenario exactly like 2008? Now, if we went through another 2008, the positions that are in there right now would cause this portfolio to lose 48% in value. Now, this was very surprising to this particular client because he had said he was a conservative investor. Remember, he chose portfolio A, so he wasn't willing to take a whole lot of risk. But then when we find out what he's actually in, there's a complete mismatch. So what we want to do to show where we arrive at these numbers is we're going to look at the first one there, the rising interest rates driven by inflation. Now you're going to see the economic indicators there, where it's showing the U.S. Treasury is projected to be at 4.75%, where it's up 2.88. You can see retail sales are going to fall by 1.44%. Unemployment would rise by 0.5%. And this particular scenario would go from $441,000 down to $360,000, which is a negative 18.3% decline. Below that, you can see how each position that's within the fund or within the portfolio would react based on that scenario. The next one we're looking at is the debt ceiling. So what if the U.S. were to default for the first time in history? Well, this scenario here has a completely different set of indicators. You can see the U.S. Treasury has now bumped the rate up to 6.31. You can see the consumer price index is up basically 0.25%. Gold falls by 28% in this scenario. Home prices fall by 16.41. And you can see this scenario would take the portfolio from $441,000 down to $231,000, which is a 47.6% decline in the value. The last one we're going to look at here is what if we went through another 2008? If this particular portfolio and the positions that he holds within it were to go through another 2008, it would see a 48% drop in value, or go from $441,000 down to $221,000. Now you can imagine the shock that this gentleman had when he said he was a conservative investor, but he's exposed to this much risk. If you're not sure about your portfolio and the positions that you're in and how they would react based on different economic scenarios, make sure you call our office and/or visit our website for your portfolio stress test.